talk more about the markets now and that jobs report with Michelle Girard. She is co-head of Global Economics at NatWest. Also joining us is David Nelson, Chief Strategist at Belpointe. Good to have you both with us. I'm going to start with you, Michelle. Just your initial reaction. You've had a few hours to sift through it to that jobs report that we saw. Do you think that this drop in job growth is temporary? And if so, how long is it going to last?
Well, I do think it's temporary in the sense that I think it reflects what we've seen in terms of rising infection rates and restrictions being re-implemented. And so I think with the, obviously with the release of the vaccine, and as the vaccine gets distributed and people, and companies can begin once again to normalize, we will see we will see a resurgence in employment, or certainly a recovery in employment. I think when I look at this report, while the overall headline was disappointing, it was a little bit worse even than we thought. We had expected a smaller decline. I think the breadth actually when you look at the details of the report, as you noted, in leisure and hospitality, the sector with which restaurants are in, they lost almost 500,000 jobs. But most other sectors, and particularly goods producing sectors like manufacturing and construction, had healthy gains. And this is very different, of course, than what we saw last March and last April. So I think there is, we are seeing obviously a repeat in terms of a virus induced slowdown, but it's very different than what we saw before, because we aren't seeing the broad-based stoppage of activity and therefore broad-based employment declines like we had seen a year ago.
Mm-hmm. David, if you look at the market activity today, it's sort of been a bit volatile, but all in all, a pretty muted response to this disappointing jobs report. And when you take a look at the market since the beginning of the year, we're only a few days into it, we've had a lot to deal with. The deadly riots on Capitol Hill, the death toll rising for the coronavirus pandemic, yet the stock market rallied to records in the face of all of that. Why is that? Where is this positive momentum coming from?
Stocks are a discounting mechanism, and they don't care about the news cycle unless it affects earnings, cash flow, or dividends. And maybe the turning point for the market, certainly in the tenor of the market and what's working, was look back to November 8th, when we had the advent of a vaccine. That was a game changer, and it was largely reflected in stock prices. Look at what's worked since that time. Energy up 44%, materials up 13%, financials 24%. That's a pro-cyclical recovery. Down there, coming in number 6 under the S&P, the market leadership from large cap secular growth and technology pales in comparison. And it tells me right now, for the moment, markets are looking through that noise. FANG right now, the very popular large cap secular growth trade, that's not the risk on trade right now.
So, David, what if someone finds themselves underinvested at the moment, and they're looking for that entry point? When you look at the market trend over the past few weeks, we have not had many, if any, back-to-back down days. So if you're looking to get into this market, should you, and when?
There's no one single point to do it. I think if you're underinvested or you're not invested at all, and I'm sure there's a lot of people out there that fall into that category, you're going to have to find some mechanism to get back in. And for most people, it'll probably be a scale back in. Put some capital to work right now, maybe a third of your portfolio, put a third of the cash to work, and then slowly get in over time on a time-based format, regardless of whether the news is good or bad. Unless you have some kind of quantitative way to trade around the wiggles, like a tactical mechanism or a quantitative approach, trying to trade around the headlines is death to your portfolio. You'll do quite poorly.
Michelle, this week, I'm sure you saw Credit Suisse came out and raised their target for the S&P 500 from 4050 to 4200. Do you think that's a little too optimistic? Where do you fall in there?
Well, I will say, I think when you look at the performance of the market this week, one of the things I am a bit skeptical of, I guess, is what I think has helped propel the market forward this week is in the wake of the Georgia election results and the Democrats with the, of course, tie-breaking vote from the vice president having a majority in the Senate, I think that really fueled expectations of much larger fiscal stimulus coming. And I think that people are sort of missing the point in the sense that this isn't like the blue sweep we had talked about possibly seeing in November, where you could have had a situation, Democrats picking up a far larger majority that may have ushered in the ability for massive fiscal spending, a $3 trillion Green Deal. This is not, even though the Democrats have that slim majority, it's too slim with the filibuster to really pass the kind of significant fiscal spending that I think is what has been driving the market over the last few days. And we saw some setback even this afternoon when some of the expectations for stimulus were dampened. And so I do think we have to be careful here in some of the basis for the rise that we've seen in the equity market. I mean, clearly a weaker employment report will put pressure on Congress continuing to do more. But I think some have overestimated what the election results out of Georgia might mean in terms of fiscal policy.
So, David, what do you think the short-term catalyst is going to be for this market? Because we're going to have earnings start rolling in very soon, but yet Biden's going to take over in the White House, and we're expecting this big, robust stimulus package. What if we don't get it? What happens to the stock market?
There's a few more risks than that. I think there are several risks for the market. First and foremost is the rollout of the vaccine. It's obviously proved a logistical nightmare. Each branch of government is punting it to the next. The administration has said they've delivered to the states. The states are passing on responsibility to the local communities. And it doesn't take an MBA in supply chain management to understand that every branch of government is going to have to work to get this done. If we don't get the vaccine right, then stocks are clearly mispriced. The second issue that I have is China is going to test the Biden administration quite early. And it could be foreign policy, economically, certainly, perhaps even militarily. So there's a lot of things to be concerned about. But right now, for me, number one with a bullet is the vaccine rollout, getting that done right, because clearly that's the basis of an economic recovery.
Michelle, the last one to you. David just brought up China, makes me think internationally. I mean, 2021 is going to be the year of post-Brexit Europe. Do you see some opportunities outside of the U.S. market for investors this year?
Yes, when you look at actually countries and regions that are going to perhaps outperform in a post-COVID world, we think, the Euro area is actually a big winner. When the crisis first began, I think there was a lot of pessimism around not only China and Asia, but also around the Euro area. And would this ultimately be the catalyst to breaking the Euro area apart? And quite the opposite has happened. What we've seen is that COVID has actually pulled the union closer together. It's effectively move them forward in taking steps toward fiscal union. It's unleashed fiscal stimulus that was unable to be put to work, say, in the wake of the global financial crisis. So I think we view the Euro area even more than the U.S. and the U.K. as a potential real outperformer in a post-COVID world.
All right, we're going to have to leave it there. Michelle Girard at NatWest and David Nelson at Belpointe. Thanks for being with us.
Thank you.